Every month, 161 million people use Uber. Last year, it generated $193 billion in bookings, the biggest year in its history. By every measure, Uber won. But in 10 American cities, something is quietly taking its rides, and Uber can't stop it. This is the story of how Uber burned through $33.5 billion, finally learned how to make money, and discovered the race had already changed. To understand what's happening to Uber right now, you need to understand what Uber actually is. Because most people think Uber is a taxi company. It isn't. Uber is a bet. When Uber launched in 2010, the idea was simple. Build a platform. Get enough drivers on it. Become so embedded in daily life that quitting feels impossible. Then, and only then, figure out how to make money. This is called the Silicon Valley model. The theory is, if you can get big enough, fast enough, you become the only option. And when you're the only option, you control the price. Uber believed that so completely they were willing to lose money on every single ride for over a decade. Not a little money. A lot of money. In the 3 years before their IPO alone, Uber lost $10 billion on $79 billion in rides. That's not a typo. $79 billion came in. $10 billion still went missing. Now, to be fair, some of that money was strategy. They were subsidizing rides to hook riders, paying driver bonuses to recruit the workforce they needed, launching in a new city every single day during their hyper-growth era. They were essentially buying market share with investor money, and the investors knew it. The check writers included BlackRock, Goldman Sachs, Google, and Jeff Bezos, who put in $37 million in 2011. By 2019, Uber went public at a valuation of $82 billion, a company that had never made a dollar of profit. On its first day of trading, the stock closed below the IPO price. It was the biggest first-day dollar loss in U.S. stock market history. The CEO called it a once-in-a-lifetime hit. That's one way to put it. Here's the thing about the Silicon Valley model. It only works if you become dominant enough to control the economics. And Uber came close. They dominate RideShare with 76% of the U.S. market. They operate in more than 70 countries and 10,000 cities. But the business model had a problem that no amount of growth could solve. Uber doesn't own cars. It doesn't employ drivers. It's a platform that connects riders to independent contractors and takes a cut of every fare. That sounds efficient, and it is, until you do the maths. When Uber launched, drivers typically kept the majority of each fare. To grow, they sweetened that deal further. Bonuses, incentives, guaranteed minimums. Drivers flooded in. Riders flooded in. The app spread to thousands of cities around the world. But the losses kept piling up. Because here's what the Silicon Valley model missed about Uber specifically. With Spotify, you sign up once, you listen forever. With Airbnb, the host does all the work. With Uber, every single ride requires a driver, a human being, in a car, using fuel, for every trip. There is no version of Uber that scales without people in cars. And people in cars have costs that don't disappear with growth. So Uber tried something else. If they couldn't reduce the cost of running the rides, they'd reduce the cost of the people doing them. In 2023, Uber posted its first real profit, $1.9 billion. Then $6.9 billion in 2024. Then another record year in 2025. The headlines were triumphant. Uber finally did it. The long bet had paid off. But the profit had to come from somewhere. As Uber became profitable, drivers started earning less. The Tennessee Drivers Union put it even more bluntly. In 2024, hundreds of Nashville drivers went on strike, saying Uber and Lyft now take 60 to 80% of the fare on some rides. At the same time, Uber rolled out something called upfront pricing. It sounds customer-friendly, but it changed who controls the fare. Instead of drivers being paid a set share of the trip, Uber now decides what the rider pays and what the driver receives. One driver in Texas explained it simply. A trip from College Station to Bush Airport used to pay him around $90. After upfront pricing, the same trip paid between $30 and $45. Meanwhile, Uber quietly increased its own share of every fare. Drivers who joined in 2015 often kept around 80 cents of every dollar. Today, many say they keep closer to half. A 2023 survey found that 44% of rideshare drivers earn below minimum wage. Nearly 3/4 said they work dangerously long hours just to make a living. So what actually happened? Uber didn't reinvent its business model. It found a cheaper workforce. The profits didn't come from a breakthrough in technology. They came from taking a larger share of every ride. And that works until drivers find something better, or until technology makes drivers unnecessary altogether. Here's something strange. Uber just posted record numbers, and the people who funded the whole thing aren't celebrating. To understand why, you need to think about what this company actually cost to build. By 2022, Uber's accumulated losses since founding had climbed to nearly $33 billion. 15 years of losses stacked on top of each other. To fund that, investors put in roughly $13 billion before Uber ever went public. Then another $8 billion came in at the IPO itself. For that level of risk, investors don't expect a good return. They expect an extraordinary one. 10 times their money, maybe 20. That's the deal with venture capital. Most bets fail, so the winners have to be enormous. Today, Uber is worth around $144 billion, which means on the roughly $21 billion actually invested, early investors made closer to 7 times their money. 7 times over 15 years in a company that invented an industry. That's a solid return. It's just not the kind of return that justifies the risk everyone signed up for at the start. And here's the part that's keeping investors awake at night. Even after record profits, Uber still carries around $10.5 billion in long-term debt. They spent 15 years buying market share with borrowed time and borrowed money. Now they have the market share, but the debt is still there. For investors to feel like the bet finally paid off, Uber's profits need to keep growing, dramatically, year after year, which would be a straightforward story, if something wasn't already changing the rules. In San Francisco, something strange is happening. People are opening the Uber app, requesting a car, and getting picked up by a Jaguar I-Pace with no driver. No one in the front seat, no one behind the wheel. The car just arrives, drives itself, and drops you off. This is Waymo. It started in 2009 as a secret Google project. In 2016, it became its own company under Alphabet, Google's parent. And for the years since, it has been quietly and methodically testing self-driving cars in American cities. In 2018, Waymo launched its first commercial rides in Phoenix. Then came San Francisco and Los Angeles. Then Austin and Atlanta in 2025. And by February 2026, Waymo launched in Dallas, Houston, San Antonio, and Orlando, all at the same time. That brought Waymo to 10 cities, with plans for 20 more by the end of the year. And this is no longer a tiny experiment. Waymo is now completing more than 450,000 paid rides every week. That's up 80% since April 2025. In 2025 alone, Waymo completed 14 million trips, more than triple the year before. And its co-CEO has said that by the end of 2026, Waymo expects to reach 1 million rides every week. And that is the part Uber cannot ignore. Because in San Francisco, the first major city where Uber and Waymo have competed head-to-head, the numbers tell their own story. When Waymo launched there in 2023, Uber held 66% of the market. Within 15 months, Waymo had already passed Lyft, and Uber's share had fallen to 55%. One Uber driver near San Francisco Airport summed it up in 3 words. They aren't a threat. Yet. Uber is not sitting still. Uber's current CEO, Dara Khosrowshahi, saw Waymo coming, and he made a decision. If you can't beat them, become the place people book them. Uber has now committed roughly $10 billion as an investor and partner across the autonomous vehicle industry. The plan is simple. Waymo, Tesla, and every other robotaxi company will eventually need riders. Uber already has them. It has the app. It has the users. It has the payment system. It has the brand. So Uber wants to become the front door for the robo-taxi industry. And to be fair, it's a smart pivot. In Austin and Atlanta, Uber and Waymo already work together. You can open the Uber app and get matched with a Waymo instead of a human driver. It's working better than anyone expected. Uber's own CEO has said their Waymo fleet in Austin is now busier than 99% of all human drivers there in terms of completed trips per day. And for now, the partnership works. If Waymo has a car available, you get a driverless ride. If it doesn't, Uber sends a human driver instead. That makes Uber useful, for now. But there's a problem with this plan. Waymo is using Uber because it's convenient, not because it needs Uber. Waymo has its own app, its own brand, its own reputation. And in San Francisco and Los Angeles, Waymo already operates without Uber entirely. Riders book directly through Waymo. No middleman, no Uber cut. And as Waymo grows, as the fleet gets bigger and the number of cities expands, Uber's value as the middleman starts to shrink. Because why give Uber a slice of every fare if you can keep it yourself? Strategy analyst Tomas Pueyo put it simply. Uber will likely ask Waymo for a few years of exclusivity in certain cities. Waymo will wait that out, then go direct, and undercut Uber on price. Uber spent 15 years subsidizing rides to hook riders. Now Waymo can run the same playbook back at them. Except this time, the economics are different. Waymo doesn't have driver wages. It doesn't have driver strikes. It doesn't have driver shortages. It doesn't have labor laws to fight. Just a car, a route, and a fare that Uber may not be able to match. Here's where Uber stands in 2026. They have 76% of American RideShare, over 200 million monthly users, record profits, 15 years of survival through losses that would have killed most companies. By any measure, they earned this moment. But the profit they just posted was built by squeezing the workforce that has been carrying them since 2010. And the technology arriving to replace those drivers doesn't need Uber's platform to reach riders, doesn't need Uber's brand, doesn't need Uber at all. Uber didn't just build a business, they built an industry. And then the industry started building something that doesn't need them. 15 years, $33 billion in losses. Record profits. Right on time to face a competitor that doesn't have a single driver to pay. Every empire has a story. Subscribe to hear the next one.